What's up, you guys? Brendan here. So today we're going to compare stocks and real estate and determine which investment is best for you. I personally invest in both. I've talked a lot about the stock market on this channel and my opinions on different investment strategies and which is best for you, but also I own 2 rental properties in Indiana. Now I'll make a future video on exactly how I found those rental properties and their profitability, but today we're just going to talk about the advantages and disadvantages to invest in the stock market and investing in real estate. Now, a lot of people are very opinionated on this topic, but really I think it depends on what your goals are for your investments and how involved you want to be in them. Now, if you're new here, thanks for joining me. The goal of this channel is to help you reach financial independence and give you the option to retire early. So let's jump into it. So I'm going to start with stocks, but first we need to define exactly what I mean by investing in stocks. So yeah, I mean investing in the stock market, but there's a lot of different strategies you can use. You can invest in individual stocks through dividend growth investing. You can do indexing. You can do factor-based investing, which is what I do. You can do really hands-on with day trading. But for this analysis, for this comparison, I'm going to focus on indexing because it's the most straightforward and the most easiest to compare to real estate investing. So what are the advantages to investing in stocks through index funds? Well, really, they're very passive investments. Right? So you just basically choose an ETF or a mutual fund based on which one's the least expensive that's invested in your target index, and then it's really hands off. You just sit back and watch it grow. Maybe every year you go back and you rebalance to make sure that you're sticking to your investment allocation, but besides that, there's really not a whole lot involved. Compare that to real estate where you may have to worry about 2 a.m. calls to fix a broken toilet, chasing down tenants for rent payments, or managing a remodel of a home. Pretty much when it comes to investing, you just find a brokerage, you click one button and you're done. You can just watch it, it's very easy, you don't have to worry too much about it, or at least you shouldn't. Some people do track it daily and get very emotionally invested and then a lot of times make bad decisions, but if you just ignore it, then really you're going to do fine. Stocks are very liquid investments. You can pretty much buy or sell them at any time for really low costs or really for free. Webull and Robinhood really push the whole market this way where there's 0 transaction fees. A lot of brokerages have followed their lead. You can also invest in REITs, real estate investment trusts, if you want to get exposure to real estate. Now the advantage of this is that you don't have to go out and find your own tenants and deal with the 2 a.m. calls and remodeling a home, and really another firm does this for you. And mostly they invest in big apartment complexes or like strip malls and stuff like that, but you get that real estate exposure without having to do the work on your own. Now, some of the other advantages, you can also invest in tax advantage vehicles, things like a 401k or a Roth IRA. This way you can defer your taxes to the future, or like in a Roth IRA, you can pay your taxes now and then watch your investments grow tax-free. Now the downside to this, at least for the 401k, is that you can't pull your money out until after you're age 59 and a half. So this is really more of a long-term play. So what are some of the downsides to investing in the stock market? Well, it's a very efficient market. And what I mean by that is that everyone has access to the stock market, so it's really hard to find good deals in the market, places that you can buy something for less than it's actually worth. Whereas in real estate, you can sometimes find that because it's not as competitive. Now, the investment market does go up over time. The stock market does go up over time. So if you just invest in a diversified portfolio and hold it for a long period of time, you'll do fine. So there are some downsides to investing in stocks. First, you really don't have much control over your investments. Yeah, you can decide which companies to buy, when and where and how, but you really don't have much control in the day-to-day operations of the company. Right? So when you invest in a share of Tesla, for example, you don't have Elon Musk on the phone with you the next day saying, which direction should we take the Model Y? Or should we begin our own battery production? Do you think that'd be profitable? Really, you're just along for the ride and you share in the company's profits. We compare that to real estate where you can decide to remodel a home or increase your rent properties, or there's just a number of things you can do to control your investment. The stock market is also a very competitive investment market. So what do I mean by that? Well, it's very efficient. Everybody has access to the stock market. So as soon as news is out in the market, as soon as news is out in the open for everyone to know, it's pretty much priced in the market immediately because there are a lot of people out there to act on that news. So it's very hard to try and find a mispricing that you can take advantage of in the market. So really, when you invest in something, it's a little bit speculation. Yeah, the stock market goes up over time, which is great to invest in, but choosing one investment over another is really just speculation on your part that you think for some reason that company might do better than the other. Unless you have insider information, Martha Stewart is an example of that, but obviously that's illegal, so we can't take advantage of that. Also, another downside to the market is that there are other areas, as we'll see in real estate, you could potentially get better returns. But there are downsides to that too. It's not as passive, a little bit more active. We'll get into that in a second. So now let's get into real estate. So what are some of the positives of investing in real estate? Well, there's a really high barrier to entry. Right? Just to get involved in the first place, you first have to save up that down payment just to purchase your first home. That creates less competition, which makes it easier to find mispricings in the market. And add to that a lot of people just like to invest in real estate locally, especially when you're talking about single family homes, so that again, you have fewer people to compete with to find those better deals. So you can potentially find a deal well below market that just needs a little bit of work, and then all of a sudden it's worth way more than what you invested into in the first place. And that brings me to another advantage. You can actually make big changes and have a big hands-on impact to your investments. You can remodel, you can change tenants, you can change your rent, you can reduce expenses. You have a lot of say over how profitable your investment is. Also, you can pretty much decide how involved or not involved you want to be in your real estate investment. Right? If you want to manage the property yourself and save a little bit of money, you can. Or if you want to outsource that to a property management company, you can also do that, and then you spend a lot less time. You can decide to do some of the maintenance repairs on your own or some of the remodel work on your own and add some sweat equity into your investment. Another big advantage to real estate is that you can leverage your money to get a higher return. So what does that mean? Well, what I'm talking about is a mortgage, right? Using debt to increase your return. When you buy a $500,000 home, you don't give them $500,000 in cash. Really, you can invest $100,000, 20% down, and then get a mortgage from the bank to pay for the rest. And you still have $500,000 invested in real estate. Now, there are other ways to invest less, but I'm just going to focus on 20% down right now. I'm not going to get into all that. But there is additional risk to this, because if the value of the property goes down, then you could potentially end up owing more money than the house is worth. But if you're a long-term investor, this shouldn't concern you too much. And also, if you've done your research and you have a good investment there, a good solid property, then you don't have to worry about that either. Another big positive to investing in real estate are the tax advantages. First, you can depreciate your property over 27 and a half years. This saves you a lot of money on taxes. And also, you can write off your expenses and mortgage interest that you pay to reduce your taxes even further. There are also things like 1031 exchange, where if you have a big capital gain in your property and you want to buy something else, you can kind of defer that capital gain into the future and buy another property and just transfer it over there. That really isn't available in anything else except for real estate. Now, what are the downsides to real estate? So it can be very time intensive, right? So first you need to find the deal, then you need to win the deal, then potentially you need to remodel, you may have to find a tenant, there's ongoing costs, maintenance fees, and tracking down the tenant to get your rent, then when they move out, flipping the property, fixing up everything that they may have screwed up, and then finding a new tenant. It can be a lot, especially if you're trying to do it on your own and not use a property management company. Now also, you need a lot more money just to begin investing in real estate, right? Like I said before, you need to save up that down payment before you can even go out and buy real estate in the first place. Now you can get in for less than 20% down, but typically then there's additional cost in your mortgage, and it could be worth it, but really it depends on each case by case, and there's also a little bit more risk involved then. Real estate's also a lot less liquid than stocks, right? So if you're trying to sell, first there's closing costs, which is usually 5 or 6%. It can take a long time to sell your home depending on how you price it. Even if you try and do a cash out refi just to get money out, there are costs involved in that, and also that can typically take 30 to 45 days. So now let's compare investing in stocks and investing in real estate by the numbers, right? So that's what everyone wants to know. If you invested in each, which is going to give you more money at the end of the day? So I'll compare each over the last 10 years. So for stocks, I'm going to use the S&P 500. The S&P 500 is just an index that's the largest 500 US stocks. And it's just an easy investment to use. It's actually done very well over the last 10 years, so it gives stocks its best chance to do well and compete against real estate. So over the last 10 years, the S&P 500's annualized return is 11.61%. This is as of May 5th. So if you invested $50,000 10 years ago in the S&P 500, today it would be worth $149,968.86. So now let's assume you invest that same $50,000 in real estate. So you find a home worth $250,000, and then you put 20% down, and that's where your $50,000 goes, to the down payment. So then you mortgage the rest. So you have a $200,000 mortgage at 4.5% rate. Now the monthly payment on that is $1,013. So annually that's $12,160. Now typically with real estate, you can find a deal that nets you around 7% per year. Now that's after all expenses, right? Property taxes, insurance, maintenance, those big time maintenance expenses like fixing your roof. So you average all that in, you calculate your income, calculate your expenses, and your capital return should be around 7%. So that gives you $17,500 in net cash flow in your first year. So reduce that by your mortgage expense, and your net profits are $5,340. But that doesn't include the principal you're paying down your mortgage, right? Your mortgage payment is made up of some of it goes to interest, some goes towards principal. So the amount of principal you paid down your first year is $3,226, which gives you an additional 6.5% return on your investment. Now on top of that, you have property appreciation. For this example, I'll assume it goes up 2% per year, which is relatively low for real estate, but it's good for this example. So in the first year, a $250,000 home going up 2% will gain $5,000 in appreciation. So after 10 years, how does this all look? Well, first you paid down principal in your mortgage, right? So you paid down $37,853 in principal. Also, your home's appreciated at about 2% per year. So it started at $250,000, now it's worth $304,450. Also, you've had tenants paying rental income throughout this whole time. So the total cash flow is $64,075. So reduce all of that by your remaining mortgage, and in total you've made $206,675.87. That's a total return of 413%, which annualized is about 15.25%. And that doesn't even include rent increases. You should typically increase your rent by about 3% per year. It also doesn't take into account the tax advantages of depreciating your home or writing off your expenses or mortgage interest. And lastly, it doesn't take into account if you bought a home that needed a little bit of work and then remodeled it and then found that cash flow. Typically you could find a home, put a little bit of work into it, and then increase the home by about $50,000 or $100,000 over what you've actually invested. So based on the raw numbers in these examples, real estate is outperforming stocks in terms of just pure numbers. But really, there's a lot more involved. It's a lot more hands-on. So you are putting in a lot of your time and effort to earn that extra return. Now, if that's worth it to you or not, it really depends on you and your goals. So which is actually better? Well, personally, I choose to invest in both. And like I said, it depends on your goals and exactly what you're looking for in your investments. If you want something that you can just click it, forget it, then go with stocks. If you want to earn a higher return but have a lot more hands-on and have a lot more control of your investments, then maybe real estate's better for you. Personally, I think everyone should invest in both. Even with real estate, if you want to be more hands-off, you can hire a property management company and do a lot less work and take a lot less risk there. Now, it'll hurt your returns, but that is an option. But really the best thing you can learn from all of this is just to get started with whatever it is. If you want to invest in stocks, then go out there, open an account and do it. If you want to invest in real estate, then start learning about it, start looking up deals, start doing analysis. There's a lot of information out there. A great place is biggerpockets.com if you want to learn more, or there's a lot of YouTube videos on how to do it. But just get started now. That's the most important thing. Just right now, go and open an account, open a Roth IRA, invest some money in there, go find some stocks or an ETF and just get started, get it growing. Because the more time you're invested, whether it's real estate or stocks or whatever, the better. So I hope you learned a lot from this video. Let me know in the comments below if you invest in stocks or real estate or both and which you prefer and why. If you like this video, please hit the like button and subscribe. Also hit the little bell icon so you don't miss any future videos. Take care. Bye.